So, what should be the asset allocation of a target date 2025 fund? It is a poll question that garnered almost 14,000 views and nearly 100 comments in just 2 days. And we are barely touching the topic because we're only discussing equity versus fixed income. We haven't even gotten into sub-asset classes. Good luck, Government Accountability Office, on your view. I was told that my question could be a bait question and was entirely too simplified. In fact, the general consensus was that I didn't even have the right answer on the board because the real answer is, it depends. Of course, the proper investment allocation for a near retiree depends. It depends on a lot of things like time to retirement, outside investment assets, personal risk tolerance, what they ate for breakfast that day. Providing individual investment advice is easy. The challenge for a 401k plan sponsor or 401k advisor is that we have to pick one target date series manager for everyone, which means we have no choice but to look for a one-size-fits-all solution. So what may have appeared to many of you as a moot question isn't moot at all. There will never be a one-size-fits-all target date asset allocation and glide path. Our challenge is to find the one size that fits most. And for those of you who may not be in this specific industry, we are having to identify our QDIA, the qualified default investment alternative that unengaged participants are automatically invested in. Unfortunately, we as an industry do not agree on what the proper asset allocation is, with our equity options at retirement literally ranging from 30% to 70%. In my informal poll, the answers were all over the board. And the same can be said for the poll that Napa did of their readers. The key word here is the unengaged participant. Our challenge is we have to select one option for many, and we don't get the opportunity to collect all of the data and ask all of the personal questions that personal financial planners rely on to provide an investment recommendation. Or do we? Enter the dynamic QDIA. Dynamic QDIAs are managed account solutions that unengaged participants can be automatically enrolled in. Through record keeper sites and payroll data, they can collect key data points like age, salary, contributions, and gender that can then be used to create individualized investment portfolios for participants. Now, before we go all Regina George and put our target date funds in the burn book, let's recap a couple of things. Prior to target date funds, many plan sponsors were selecting the money market fund or the capital preservation fund as the QDIA, regardless of the participant's age. Many of us agree that in the accumulation phase, target date funds can provide an excellent way for the unengaged participant to diversify into a low-cost portfolio that slowly glide paths into something more conservative as they age. Yes, there is an education gap. We have to clarify things like your money's not locked up until that year, and no, it doesn't automatically turn into cash in that year either. But the general consensus is target dates are a good and have been a good solution for many of our plan participants. There is also a general consensus, though, that as our participants enter that de-risking retirement red zone phase, so we're talking 10 to 15 years from retirement, they could benefit from a more managed solution. In addition to basic data like income and age, dynamic QDIAs, if you have engaged participants, may also be able to collect data like outside investment assets and personal risk tolerance to provide a really great custom investment allocation. Now, originally, I shied away from managed accounts in 401ks. The cost at the time just felt excessive relative to a target date fund. However, with technology and innovation, I'm surprised to report that some of the cost of the managed QDIAs are much lower than they used to be. And with technology, we can implement them with ease across many participants and potentially across different plans. So, plan sponsors, here's what you need to know. Number one, if your advisor has not talked to you about a dynamic QDIA or you have not had a thorough review of your target date fund, including asset allocation and glide path, then call me. It's something we need to discuss. Number two, evaluate your plan demographics. If most of your employees are in their 30s, then you may pay particular attention or assign more weight to that phase of the glide path than, say, maybe later phases, and vice versa. And finally, evaluate what your particular participants are doing at retirement. Fidelity found that 55% of their retirees didn't touch their 401k a year after they retired. And that number is trending up. So are your participants cashing out and moving their money at 65, or are they keeping it in the plan? Because that will be a key data point as we discuss to versus through versus managed target date funds. So with more than 60% of retirement plan assets now in target date suites and a call from congressional leaders for them to be reviewed, I can imagine that we are only starting our discussion around this topic. Leave your thoughts in the comments below. That's it for this week. This is Jeannie Fisher, the 401k Lady.